Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on there? December 18th. I'm Marin Katusa, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. You know, it's interesting watching the financial media shows this week. Actually, maybe not this week. We can go back for the last 3-4 weeks. And I hear comments when I talk about this, and so many people email me, oh, these shows are complete BS. And, you know, of course, everyone goes on there with an agenda, like they're supposed to. You know, they're just bringing more attention to the stocks in their portfolio, or maybe brag about the calls that they made. I mean, it's normal. I'm not picking on, making fun or anything. But these shows are actually very, very important. And there's a reason why I watch them every day, or at least have the TV on tuned, you know, at my office to CNBC most of the time, where, you know, I'm just looking at the headlines, seeing what's going on. If something I like or someone I see that I like, you know, I'll put the volume up. But it's pretty much on all day when I'm at my office. And there's a reason why I watch it every day. It's because these shows are one of the best ways to gauge investor sentiment. I mean, you can ask yourself, are the analysts negative that are going on there? And all the people go, are they negative? Are most of the headlines on the bottom of the page while these guys are talking or throughout the day, are they negative? By negative, maybe, you know, the trade deal with China is not going well, you know, impeachment, which, you know, obviously could have a major effect on the stock market if Trump was getting impeached, which 100% he's not going to, because he'll never go through the Senate. You know, to talk about earnings, right? There's a year-over-year decline in earnings that really no one's talking about. And yes, we know earnings grew tremendously from, you know, the tax reforms 2018, but year-over-year, they're supposed to pick up a lot quicker next year. But year-over-year, they're negative. You talk about geopolitical risks in North Korea, you know, so you see these headlines on TV, and not only could you gauge the overall sentiment of the market by paying close attention to just the tone, right? You know, if it's negative, it's positive, but also for certain sectors. I mean, you look at oil right now, everyone's bearish on oil. And it makes sense. Companies need to produce to pay their enormous debt commitments, which they pushed out 3 years ago to kind of now. So they produce one commodity. The prices have been kind of coming lower in oil, been weak. But these guys have to produce in order to make money to pay down their debt. So you're looking at that. If you think about it for a minute, we have lower oil prices, yet supply is going to continue to rise, which basically means oil prices are probably going lower. So that's why you see most people negative on the oil sector, almost everyone, right? At least over the past few months. Now, for me, I use this sentiment as a gauge. And this is one of the best indicators you could use, one of the best indicators I use. And I use it to actually be a contrarian investor. For example, everyone hates oil, and rightly so, just based on what I told you. But these conditions have pretty much been the same for at least the past 12 months, almost the past 18 months. And most oil stocks, even the high quality ones, have collapsed. They've been, you know, the worst performing sector. It's been terrible outside of materials. A lot of that could be factored in. And maybe that explains why energy is one of the top sectors seeing inflows right now from institutions. This is according to Merrill's hedge fund monitor, which they track trillions of dollars in institutional money and it's the so-called smart money, which is hedge funds, money management, you know, these every single week. Seen a lot of money push into that, even though everybody that I see on TV is negative. Now, I'm getting to a bigger point here because I'm going to surprise the hell out of you right now. As you know, if you're listening to this show, if you follow my newsletters, you know, I've been telling you just to buy just about every single dip over the past 5 years. I got cautious in 2017 because I saw slower earnings growth, but then Trump passed the new tax reforms and we saw earnings in 2018 skyrocket. But overall, I've been extremely bullish, and not just because earnings are very solid. You have interest rates very low, and looking, you know, back historically, the stock market was never really super expensive over the past 5 years. It's trading at around 17 times forward earnings, and below that level probably since like 2011, 12. And the 5-year average is around 15.5. So you can say, well, a little expensive, but that, you know, when you're going historically, we talk about interest rates being much, much higher. I mean, you could say stocks could be trading at 18, 19 times earnings and still be relatively cheap because you can't really compare it to a time period, especially in the 80s when interest rates, you know, mortgages, whatever, 20% is crazy. Another reason why I was optimistic, there was still a lot of bears out there saying the market's going to crash 30, 40, 50%. I kind of like enjoy making fun of these guys because they've been saying that since, the day they were born for the last 50 years. That's okay because they're perma bears and you have perma bulls, whatever. That's cool. You have your own audience. That's great. But even if you look at top investment banks, Goldman, JP Morgan, very cautious on owning stocks through 2019. Now, I always thought that was a good thing because of my 25-year plus history of analyzing the markets and also as a portfolio manager as well. I never, ever saw a market crash that everyone was predicting. It doesn't happen. Crashes don't happen that way. They catch you by surprise, mostly when everyone's leaning to one side, which is the bullish direction. That's when the biggest crashes happen. That's when everyone's like, what the hell happened? What's going on? Look at the credit crisis. Look at 87. You look at the recession 2001, too. Even last year around this time, that caught everybody by surprise when the market fell, over 20% in the last, I think, September through the end of December, and really collapsed in December. Caught a lot of people by surprise. Like, what the hell's going on? And of course, we rocketed higher, and we're having a great year this year. But when I look at the markets, and please listen up to this, because you guys know I'm not a perma bull or a perma bear. I can't find a bear anywhere. In fact, even the biggest bears are saying that stocks are likely to go higher in 2020. Why? Well, it's an election year. Trump's focused on ASP 500. We have low interest rates. The Fed's going up saying we're not touching anything. There's no inflation, so they're going to keep rates low forever. Pedal to the metal. And you know what? That scares me. But watching the financial media shows today, you have to find it funny that the analysts who were telling me to get the hell out of the market over the past 3 years are the same ones after the market is up tremendously over that time frame. The same ones that are extremely bullish now. I'm not going to go into individual names, but I will tell you that Goldman, JP Morgan are very bullish on 2020 all of a sudden. Yet they were telling you beginning of 2019, we're cautious. Maybe it's out. Look at the headlines. Google it. And when I look at TV, you can't find a single analyst anywhere. If you look at Fast Money, you look at, Kramer, you look at everything, there's nobody bearish right now. It's not even like, well, there's a couple of guys. It's like zero. These guys aren't even saying, hey, let's take profits in some of the sectors that you made money in or be cautious. Just buy. Just keep buying. And for me, when I see these types of conditions, this type of sentiment, where everyone is leaning to one side, you know where I'm going here. Usually means the opposite's going to happen. I'm not telling you to sell all your stocks right now. I'm not predicting a 40, 50% crash. We have a momentum train that's going downhill right now. You want to jump in front of it. So probably see stocks continue moving higher, at least through January. Plus, if you're looking at the overall market, a lot of the gains in the big indexes are mostly due to a select few stocks. Look at Apple, biggest stock in the world. Just pull up a chart of Apple, how high it's gone. It's incredible. Facebook, Google, the biggest technology companies in the world, the biggest bank, JP Morgan. Look at the charts. Some of these things just keep going higher and higher, and it's a higher concentration, a lot of these indexes. So not all sectors are at 52-week highs. Energy, materials are not. Lots of small caps trading 30, 40% off their highs. But I have to tell you, I'm cautious right now. Okay, from someone who's been telling you to buy the dips and telling you, stocks going to continue to hit all-time highs, and they have, but they're going higher a lot faster, especially over the past few months. And by me saying this, I'm not sure if that makes me more credible than the next analyst. I'll let you decide that. But to be honest, I give a shit about you. You know that. I don't want to see you lose the gains you made in the markets over the past few years when this market collapses because nobody's scared. Nobody's worried. It's an election year. They have to go up. Does that mean, but look how much they went up this year. They went up much. Nobody had them go. No one had stocks going up that much this year. Nobody. They had them rebounding. It's pretty crazy when you look at these gains this year. So for me, I suggest taking some profits in some of your biggest winners. I'm not talking about selling your stock out completely. I don't have a crystal ball. I could be wrong. Believe it or not, I can be wrong. You guys know because I cover my losers. I am wrong sometimes. But take profits maybe in some of the tech companies that you're up over 50% on this year. And why would you do that? Because it's a win-win for you. I mean, think about it. If the stock goes higher, you still own it. I know it's not a full position, and your greed kicks in, but you're making money. If stock goes lower, you're not going to be pissed off since you sold half, and you can even use that money to buy back into the position if it goes lower. But I will say, don't take profits right now before year end, right? I mean, most sectors are up. You're probably doing well. That means you could end up with huge capital gains that you're going to be taxed on this year. Again, so you should be sitting on a lot of winners. But just a strategy to think about in early January. I just think it's a good idea to take some profits. But more important, in 2018, I launched a new newsletter called Money Flow Trader. And it was to use option strategies to bet against stocks. For me, I thought the time would be perfect. I mean, someone who follows the market. Look, we're up tremendously. This is right after tax reforms. A lot of this is baked in. And so many stocks have had an incredible run. But it's been a screaming bull market since then. Again, next year, I'm not predicting a crash or a 30% decline. It is an election year. I've been telling you that. And we have a president that knows, the biggest indicator for him to get elected is the S&P 500. He understands that. But we could see a rotation out of tech, maybe into materials, energy, value. And I'm not saying we could. We're actually seeing that now. But I think next year, you're going to see a lot of names get hit. Because when I'm doing my research right now, it's not as easy to find new ideas. I mean, a lot of these things are trading at crazy valuations, only because the overall market continues to move higher, especially in the tech sector. But if you're subscribing to Money Flow Trader, I have a feeling that's going to be one of our best performing newsletters in 2020, simply because there are tons of names to choose from right now that have huge downside. And think about it. If you looked at the S&P 500, right? Those 500 stocks. And think about if you went through every single one of them, which you won't, which would require a lot of work. How many do you think you'd be buying right now? Right now, today, after this move higher? I think you'd be more inclined to sell much more than 50%, maybe 60% of that index. Because again, it's concentrated where a lot of the biggest names have had the biggest gains, which is pushing the sector up. But if you look, it's not the whole S&P 500 that's going higher, or it's gone sharply higher. It's, technology has been a big deal. If you're not a Money Flow Trader subscriber, that's cool. I'm not here to promote the newsletter. I'm not going to offer you a special deal. I'm saying that if you can, and it shouldn't be difficult, find a way to hedge your portfolio a little bit. Be smart. That could be using option strategies, which is, what Money Flow Trader is all about, or even using inverse ETFs. You can go to any single sector, look it up on Google. But I suggest hedging yourself a little bit here, even if that means selling 1/3 of your positions that you're up a lot in over the past 12 to 18 months. Again, if you're wrong, or if I'm wrong, I should say, right, on this forecast, you're still long, right? Stock market's going to go higher. You're still long. You still only half the position. But if I'm right, you're going to have a lot of dry powder on the sidelines to put into a lot of ideas that may be down 15 to 30% over the next few months. I know what you're thinking, 15 to 30. I'm not calling for the market to fall 15, 30%. It's a big number. I'm saying individual ideas. But when you look at the statistics, those aren't big numbers between 15, 30% decline. And just look at what happens when a momentum name misses earnings or guys lows. It gets smoked. These stocks fall 20% plus in the blink of an eye. You want proof? Shake Shack, Dollar Tree, Pinterest, Grubhub, Etsy, Twilio, Wayfair, Kohl's, Movado, Kirkland. These are names that you heard of. These aren't names that, what do they do? Where are they from? No, these are quality names, brands that you see all the time that you're familiar with. Yet every one of those names I just mentioned fell between 15 and 30% right after they reported terrible earnings. I mean, you can look to the Lyfts, the Ubers, Beyond Meat, Smile Directs, some of the biggest IPOs of 2019. They're down huge. Nobody talks about them. Everybody thinks all stocks are high. It's not. It's not all stocks. But the valuations on some of these names are very, very scary, where they cannot afford to make a mistake. If they meet their earnings expectations in next quarter, which would be the Q4 quarter, but they lower guidance, these things are going to get nailed. I mean, they're trading at premium valuation someday, special technology, 25, 30 times earnings. Even Apple's getting up there over 20 times forward earnings. But I suggest you be prepared, especially for these types of drops in individual stocks, since I'm looking at a market where nobody is bearish. And when that happens, I know it's hard. I like being on the island by myself. It usually means you're right more times than you're wrong. But you have to admit, there's not a lot. You may be able to say, well, this guy's a bear, this guy's a bear, but they're not out there. They're not saying anything. Everybody is completely bullish, just saying it's election year. Trump's going to do everything he can to get the market higher. It's going to go higher. He can't do everything he can if everyone's really taking profits, but at least you're definitely going to see rotations, and you're starting to see it now from technology into value beaten up names, into energy, and also material stocks. That's where the smart money's going right now. It's easy to track with 13 Fs, if you have the right resources, which we do, with the Merrill Lynch and Access sell-side reports and things like that. But just be careful. Again, I don't have a crystal ball. I could be wrong, but I haven't seen sentiment and people this optimistic on the market going into next year. I mean, I can't even remember. I don't even want to put a time frame on it. I don't know anyone that's like, hey, you know what? I'm just taking profits and going into bonds. No, nobody. So just be careful. Let's move on. Let's have a great interview today with Marin Katusa. Marin's the founder and CEO of Katusa Research, one of the best deal makers in the entire resource industry, which you're going to find out about right now. Fantastic. Put together an amazing deal. A lot of you were invested in. It's doing very, very well right now. Marin's also a good friend. And today he's going to break down the junior resource sector, companies that he's looking at. He's very specific. He's not investing in a lot of names. And talk about how to position yourself going into 2020. And then Marin's going to break down the uranium industry, a new stock that just came public, uranium royalty. She's a big investor in. I'm an investor in as well. He's going to talk about it because it just came public. Very exciting. It's going to let you know if now's time to get into this sector and why you better be careful on what stocks you own in the uranium sector. Seriously, if you own stocks, any stock in the uranium sector, this is a must-listen to interview. And then finally, he's going to share three ideas, and not just stocks that are going to go higher 2020, junior resource stocks. Actually, it's two junior resource stocks and one larger stock, but believes that these three companies are actually going to get taken over, and probably in the first half of the year. So enough of the intro. Let's get to my interview with Marin Katusa right now. Marin Katusa, thanks so much for coming back on Wall Street Unplugged.
Oh, it's a pleasure. I was wondering who dropped out for you to call up the B team.
I know. There was about 7 people that dropped out. So then, it's been a while since we talked. I know you've been crazy busy. I've been crazy busy with a lot of stuff, even on the personal side as well and business. So I'm glad to have you back on, man, because, no one gives us a better perspective of the resource market than you. And I want to talk about what you're seeing in the industry. So we had a pretty good year if you look at gold stocks, right? A lot of the majors, royalty companies did well as gold pushed higher. But we didn't really see that follow through with juniors. And do you think that's going to change in 2020? You're becoming more selective? Is it just like, hey, the whole sector is going to rocket higher? What are your thoughts going to 2020 for the juniors, which is the market that you cover the most?
It goes back to what I said. It's all about, selecting the right team. We published our numbers. Our gold stocks are up over 45% year to date. So you don't need 30 stocks. Like the days of following some old guru that has 3 or 4 analysts writing for him that, can't own any of this stock and they have 25 gold stocks. You don't need that. Just pick 5 of the best ones, and you don't need to have your whole portfolio exposed to gold. So let's like, what's going on now? So at this time last year, you had the big Rand Gold and Barrick, and then you had Newmont and Gold Corp. So everybody thought, okay, that's it. This is all going to, no. Look what's happened with, for example, Equinox. You saw the beginning of the company. It started here in my office. Now they're a top 10 gold producer within 3 years, and they're rocking. It's been a great year for them. All in sustaining costs under $1,000. But if you look at the pattern, Ross Beatty's writing another $40 million check to maintain his 9.9% of the company as his chairman. That's the type of teams you want to follow. Another stock I talked about on your podcast that's over a double this year for us is Liberty Gold. Now, that's a junior. It doesn't produce anything, but you look at the management team. You got Cal Everett, Moira Smith, brilliant geologist. The Black Pine deposit is going to be a monster. And, I introduced, my old buddy Ron Peratt, who discovered Long Canyon, and took him down to the site, organized it for him to kind of follow up my own research after our 2 site visits. And he thinks it's a monster, so he's joined the team. And these are guys that don't do this for the money. They do it because it's their passion. Like Ron was involved in Twin Creeks and Long Canyon. Both companies were sold for $2 billion or more. So you got to be super selective, Frank. And moving forward, one thing I've been writing about for a while, it's about the cost of capital for that acquisition. So what do I mean by that? Let's use Equinox as a real life example, because all my subscribers and a lot of your subscribers have watched the inception of that. So in 3 years, the company went from an idea to now it's going to produce over 700,000 ounces of gold. And by 2021, it'll be doing a little over 1 million ounces of gold. That's some serious production now, okay? When we first started, our cost of capital, when you did equity and the debt was around the 12%. Now it's about 4% with the banks. So bigger is better from a bank's perspective. It's almost like the mortgage nonsense, but that's the reality from the bankers, and it's all about cost of capital. So if you're like a one little mine company and you're saying, I'm going to go develop this, okay, well, be careful when these analysts or whatever analysts you're following, because they use an NPV of 5, a 5% discount, net present value of a 5% discount. But the cost of capital, we just said, for a little junior with one asset, it's going to be somewhere between 12 to 15%. So right off the bat, your analysis is wrong if you're using a 5% discount, because you need to be doing the discount of your cost of capital and then add on the inflation rate. Do you see what I'm getting at? So the whole industry upside down has to restructure itself on how do we present the numbers and value. So where I believe I'm positioning myself, remember, Frank, like I'm a big shareholder in these companies and my subscribers, is what is the next cycle? I think the mid-tiers and the big caps are actually getting away from the risky jurisdictions. Again, it's about cost of capital. People went to the DRC. People went to areas in South America and areas in Africa. I nicknamed certain risky jurisdictions as like the AK-47 areas because it was so cheap to get in there, and it was cheaper than the North America. But now there's incredible assets in North America that are trading at a lower discount than these risky places in, let's say, somewhere in Africa. I'm not trying to pick on Africa, but let's just, somewhere in Africa. And you sit there and go, wait a second, I kind of like Nevada or Idaho. And, I can take my kids there and have my wife come over for the weekend versus popping on body armor. Like, I've been there and done that, and it sounds cool, and it's a great story for newsletter writers to hop around the world and sound like a Indiana Jones. But that's not how you get wealthy. It's a lot easier to go down to Nevada, which is, an incredible jurisdiction, or Idaho. That's kind of where I see the bigger companies trying to look at the Australian invasion. The Australians are using their lower cost of capital to take over the North American companies. They're coming here. So that's the trend. That's where I see it happening. And you want to position yourself in assets that are advanced. Management has skin in the game. And I believe that there's takeout opportunity in the market right now.
I want to go back to the Equinox deal, because I was one of the ones that really saw it firsthand of what you were doing behind the scenes. And if I had to guess, because I've seen you put together lots of deals, the quality of people that are involved in this deal, the amount of work that you put in. I mean, if I had to guess, I'd say it may be, if not the top, at least one of the top deals that you ever put together. Explain that process, because even when you put it together, I know there was some doubt in shareholders because the market wasn't that good, and now just to see it come to fruition, and it didn't take that long. 3 years is not a long time, and yet, in this market, everybody wants 300% gains tomorrow. But talk about how everything came together, because you're talking to a lot of big players, which means a lot of big egos, but you were able to get all these people together. I remember going to a dinner with you. Talk about that process, because that was pretty amazing, man.
Well, I guess to deal with big egos, you have to have a bigger ego. So let's start with that. But you were actually on the plane when the inception started. It actually started with David Lowell, who he's an absolute legend. Like, remember when we were walking through, mm-hmm. and you and I spent 3 days with him just going through geology. Like, what a treat that was.
Yeah, it was amazing.
So anyways, long story short, on the flight back from Alaska, by total fluke, David was sitting beside me. And and we just looked at me, and you know how he has that, he's an older fella, and he was just staring at me, and I smiled, and he goes, Marin, he goes, let's do a deal together. He goes, I want to be a partner with you on something. And I said, David, and remember, we're coming back from the Northern Dynasty site visit, which he put a big, he wrote a big check and all that. So he goes, I just like the way you roll. And I said, David, I'm trying to slow down. And remember, that was the day before my house flooded. I was just dealing with so much like stuff at that time. And he goes, Marin, you remind me of my partner 40 years ago. He goes, when you walked into the room, he goes, you looked like him, you act like him. He goes, I had to do a double take. I thought like it was a reincarnation. And I go, oh, whatever happened to him? He goes, oh, he died of a heart attack. And I went, no. So that touched me pretty quickly. And I said, look, David, I don't want to do another deal. And I go, but do you have any, orphans, things that haven't worked out? Because I never walk away from a deal. And he goes, yeah, I've got this thing called JDL. And if you recall, it was named after him, James David Lowell. And I said, well, I got this thing called Gold Mountain. And he goes, let's do it. And I said, are you going to run it? He goes, no, I was hoping you were going to run it. I go, no, I can't do that. So I kind of, went through my mental Rolodex, and I thought, well, there's another guy that I believe in, and his name's Greg Smith, and that was Anthem United he was running. And it's kind of a toll milling kind of company. I tried to negotiate with them like 4 years earlier, couldn't come to terms. And that's how Marcel and Dave DeWitt and Nolan got involved. So Nolan Watson from Sandstorm. So essentially we landed that night. I called them all up. I said, let's meet tomorrow. And that's how JDL was structured. So all excellent guys. You got the Sandstorm guys. You got David Lowell and his team, and then me and Jim O'Rourke, who you've met many times. And that was remember when we started Copper Mountain, we were pretty confident we were going to sell Copper Mountain. So we said, hey, we got this great team. And I wanted to get out of copper. I wanted to do gold. So we created Gold Mountain, right? You have the brand and, Jimmy liked the mountain theme. And it just, the market turned around and so we created that. So we looked for a bunch of assets, and we had about $70 million in cash and, a couple of assets, but nothing world class yet. And that's when the guys who were running Luna, Christian Milau and David at the time, they came to me and said, hey, we would like you to, potentially finance this. And I said, I don't like your structure because there's a fund there. And it was called Pac Row out of Australia. And Pac Row kind of had the company over a barrel. So nobody could really do anything with the asset because this one fund kind of dictated the terms. So I met with the fund manager. Him and I crossed swords, and I think I got the better of it. I won that battle. And then from JDL, we took over Luna Gold, and that was when Trek was created. Now, I hated the name Trek. And during that time, it was very difficult because we had one good asset that we were trying to put into production. So the cost of capital, like I said, was around 12, 13%. And I knew to be competitive and to execute the business plan, we had to get bigger assets. And, there was only so much more I could finance the company and be like the lead order. So that's when I pitched Ross Beatty on his assets. So, this is the thing about winners. They never, ever, ever give up. He had something called Anfield that didn't quite go well, but he had around $55 million in cash. At the same time, a guy named Richard Wark, who we did an incredible deal in Colombia with. It was a massive win. And Richard and Ross were very close, and that's how the three-way happened. And because I didn't like the name Trek, I said, Ross, I'm going to come up with the name. And that's when that night I messaged him a bunch of names. I go, I think the best name for this would be Equinox because it was the first company you sold, and I think this will be your last deal. He loved it, and that's how Equinox was created. And then we had the Castle assets in California. We had the Luna, and then Ross was the spearhead to go get the Mesquite mine, which is a kind of a lower grade but heap leach, low cost asset in the U.S. So then that was how we had the two operating mines, and then Ross went and spearheaded just recently and took over the old Gold Corp asset in Mexico, El Pilar, through Lea Gold, and now we're at 700,000 ounces of gold. And that sounds easy, but it was not. And no deal in the last 20 years has gone from zero to 700,000 ounces in 3 years. We're the first to do it.
Yeah, and that didn't sound easy. That's why I wanted to explain it. How many moving parts, not just the projects, the people involved in these projects, getting the right people together, and it just goes to show you how much the boots on the ground is important, right?
But here's the best part. Yeah. Here's the best part, Frank. Your subscribers and my subscribers and myself and you, we got in at the same price on the same terms as management. we set a record for the exchange for most subscribers in, because usually it's like, 4 or 5 big fund managers and, some of the big boys, they get all the seed rounds and then they move it forward. There is no cheap paper in this. Ross Beatty's cost of capital is the same as our subscribers. So, this deal doesn't need $5,000 gold. It works at today's gold prices. And that's the difference of, what you and I are doing by writing checks alongside subscribers, because trust me, there was many, many nights where I'm sitting there going, how do I make this work? And you're right. There are many nights when the shorters and the short and distort, and there's just groups that don't want to see you succeed. And, the gold market was shaky, the resource market was shaky, and you go after a deal and you don't get it, and that, people see, okay, well, what are they going to do? Nothing's easy, but you just don't give up.
Nah, it's great stuff. And speaking of writing checks, your check was much larger than me in this particular company, but there was a lot of buzz around a company called Uranium Royalty, right? Which, Amir Adnani, was one of the people put together. He was a good friend of ours, great friend of yours, and one of your best friends. And it just made sense over the past couple of years. But yet uranium, I think people are surprised, especially over the last 2 years. We haven't really seen any gains, or, I know you've been calling for to be a lot weaker than expected. But now this company just IPO'd. Talk a little bit about that company, because yes, we are investors in that company, but it just IPO'd now. And I want to hear your thoughts on it, because they were able to raise a lot of money in a terrible market. But even the structure and the way, compared to every other uranium company out there, which are not a lot, right, that you can really put a lot of money into. There's a lot of juniors out there. Talk about that deal, because that just went public. That deal I've followed along the whole entire way, at least, the last 2-3 years. Talk about that entire process.
So, Amir's the spokesman for the uranium sector in the West. So right off the bat, you start with the best people, him, Scott, their whole team. They're just winners. They know the industry. They've been in it in their whole lives. Not a better team out there. So start with that. And I knew I took a very different view than even Amir on the spot price during the time. And Scott, you know Scott well. And, here's a guy that was the president of Cameco USA. He was advisor to the world's largest producer in the world, Kazatomprom. And he's like, Marin, it's going to go up. I'm like, I just don't see it. And here's my reason, the whole cut to kill. So let's move forward. And I said, people forget that uranium is a massive byproduct in a lot of mines. Like, there's copper mines that produce uranium. There's gold mines that produce uranium. And people are like, really? I'm like, oh, yeah. Uranium is not rare, but the problem with a lot of this stuff is you're dealing with radioactive material. So how do you deal with it? And there's cost to that. And that's the byproduct. But then you look at the primary production. It's, again, about cost of capital. So if you look at the royalty companies, Franco trades at 2.4 times NAV, net asset value. Now, a mining company that's going to try to go build something is trading at, let's say, 0.4 NAV. So you're talking about a 6 times different in cost of capital. Who's going to win that battle? So it's a lot cheaper for the mining company to go and deal with a royalty company and stream or do a royalty on a portion of their production to advance the asset. Now, interestingly enough, just in the last 90 days, there's been a bunch of deals that we're looking at and you see, but the uranium developers and producers are off 20% because the price isn't there. Now you're in tax law season. So for these guys to go and issue paper to raise money the traditional way through a financing or private placement, it's now 20% more expensive for them because of the discount to their NAV. So does it make sense for them to do that? So if you we're the only pure royalty streaming company in the whole royalty sphere, and there's some senior executive, the presidents and chairman of other royalty companies that participated in this financing because they're like, we can't do this because it's not like gold. Like, you got to have true expertise on radioactive material, how to do that. Interestingly enough, the company went and said to the exchange, we're going to raise $20 million, over $50 million. I think it was $55 or $58 million in demand came in, and then that's why they raised 30. Interestingly enough, too, if you look at how the retail audience, because I was a big voice there, because I started out as a retail guy in the crowd, and I said I want to, have a bit more influence in the, like the Rick Rules of the world. The retail guys got pulled back less than the institutions, and that's the first time that's ever happened. So that is a big thing for me, that the retail guys get a front row seat and get the institutional guys in the back seat.
Talk about what a royalty structure is, which we both know about, but I want to get the audience involved here because, I think what people may not understand is these basically financing companies, right? So you don't have a lot of employees. They're not, it's not a company that's, building or has production costs or anything. They basically see a project and say, okay, well, we're going to, we'd like to take a piece of this project. And once you produce, we're going to get a certain percentage. I want you to talk a little bit about that because the question I really have for you is I would think there are people lined up around the block that have uranium assets that are looking to partner with somebody because, uranium's low, the sector, hasn't really been doing that well. I would think it's definitely in uranium royalties' favor, in your favor, where I think people, I wouldn't use the word desperation, but I could picture you guys getting amazing deals because they're looking for funding right now, right?
A lot of the, people, a lot of guys go, hey, how did you do what you do? And I said, well, it's kind of, I'm not the smartest guy in the game. I don't think I'm smarter than anyone. I'm just a hardworking guy. But the key is to be one of the few people, and there's very, very few guys in this sector right now. And rather than exposing myself to the exploration risk, the development risk, the production risk, the royalty strategy, the longer uranium stays lower, the better it is for the royalty company. Think of doing a gold stream back in 2003 when gold's less than $500 an ounce. That's what we're doing in the uranium sector. So, for example, I just say a mine wants to produce 2 million pounds a year, and we say, okay, they have a runway of 3 to 5 years before they start producing. We say, okay, we'll give you 20 million today, or 30 million, or whatever number they need, and we will take a percentage of your production. And we'll agree to it at a certain percentage of the spot price. So hypothetically, let's say we'll take 5% of your production, and we'll take it at 15% of the spot price. Moving forward, rolling over. So if uranium gets to $100 a pound, we pay $15 for that. Moving forward for the life of mine on all of the asset. So then, if there's a discovery somewhere else, and the best place to find more uranium or more gold or more copper is where there's already the gold or copper or whatever, you get that royalty stream stays on that asset, right? So if you look at the big successes of, any of the royalty and streaming companies, that's the whole point. You don't take any of the risk, but you're providing a very key feature for these companies, and it's really financial alchemy, if you want to, as close as alchemy as you can have, are the royalty companies because their cost of capital. And in a world where so much money is managed by the passive guys, these passive management, they don't really want to assess the difference between these 3 or 4 companies, but they like the royalty model because it's liquid, it trades above NAV, it's easy to understand. You don't have the risks of the producers and developers, and you see that's why a Franco and Silver Wheaton and the Royal Gold and Sandstorm trade at significant premiums to their NAV because you have all that upside and you don't have the actual production risks. And the market, that's where it's going.
Matt, when I look at this too, I mean, I've never really seen an industry like this because even with the royalty companies, and there's even royalty companies on the oil side, even royalty companies on the healthcare side that I'm familiar with. But when it comes to uranium, I mean, if people really want to put money into uranium, they could do it through like juniors, which are not really liquid. And a lot of these companies just, they just diluted the hell out of themselves in the past 3-4 years. They had to, right? I mean, not generating revenue and the price has been down and they still need to explore as much as they can. But it's kind of like Cameco, and then you have UEC, and then nothing else. But with uranium royalty, from what I hear from big investors, they're looking for a way where they could take a position in this, because I think there's not a person out there that doesn't think, 5, 6, 7 years from now, probably going to be less than that uranium prices have to go a lot higher from here, and this industry is going to be booming again. But to me, it's amazing how this is a perfect company where if you really want to get exposure to uranium, here it is. And not only that, like you said, people don't realize with royalty companies, it's better when the price is low because that's when you're going to get the best deals. And you want to lock in the most deals, right, before these prices go up, which eventually they will.
I agree with you. Like, for example, if you're, 2 years ago, a company made a big splash called Yellowcake. They have a very, very strategic alliance with Kazatomprom, and it really kind of it just has a better deal than Uranium Participation Corp on all metrics, right? They don't have to go into the open market to buy uranium, whereas Uranium Participation Corp has to. So every time Uranium Participation Corp goes to raise money, the trading of the uranium is such a small market that the buying that Uranium Participation Corp is forced to do, because that's what their use of proceeds are, they themselves up the prices, and these guys are playing against, the traders are playing against the company. Yellowcake gets the uranium at a discount to the spot straight from Kazatomprom. Remember, Kazatomprom produces 40% of the world's uranium. It's the equivalent of OPEC and Russia in one company in the oil sector. That's how dominant they are in uranium. And then the largest shareholder of Yellowcake is Uranium Royalty Corp. A lot of people may forget that. You know, we have the biggest stake in that company. And we also get the same terms moving forward as Yellowcake with Kazatomprom. So if you want the exposure to pure Yellowcake, we have that. We have the exposure to royalties. There's many things that we're, when you're looking at doing, and I'm not here to promote the company, and I don't get paid by the company, never got a penny from the company on all this. I paid $1.50 for the paper, just like everyone else here. I was the lead order, but I put my money where my mouth is, and I'm going long on it because, man, I've been in the uranium market for almost 20 years now, and I just don't want to be banking on these geologists and the, hoping for $50, $60 uranium, because at that point, the big money has been made, and you don't want to get stuck in these, illiquid stories based off of pounds in the ground and all that. So it's how I've decided to play it, Frank. It's created me to be public enemy number one in the uranium sector, because all these companies, what's their number one pitch? The uranium market's cheap. Buy our exploration assets now, because when uranium goes to $50, we're going to be worth 10 times. Then you got Marin up on stage saying, yeah, I actually don't think that uranium's going to go up that fast anytime soon. And if you're smart and strategic and an alligator, you're going to want to sit back and pick off all the royalties and streams. And then when it goes really to $50, then you're truly laughing financially. The market don't like it, but that's the way to go.
Yeah, and it's interesting that you say that too, because I hear the same pitch, and I've heard the same pitch for the past how many years. But yet with these companies, there's still, yes, uranium prices listen, gold prices went higher, and for the first time that I know, you cover the industry much longer than I have, we haven't seen juniors participate. Like in the market, if you see a certain sector like raw higher, the smaller, terrible stocks go a lot higher usually, right? It's the crappy ones you want to own that usually go much higher along with the rest of the industry. And same thing with a downward market where those are the ones that are going to get hit the most.
And I think that's going to be like uranium too, because it's all about cost of capital and passive funds. There's more money being managed passively now than actively. And like I said, they don't want to pick one gold company out of 300. They'd rather play the royalty or the big caps, right? So that's the new normal. Like, that's just the reality. And I think our markets haven't figured that out.
No, it definitely makes sense. I mean, even when I look at some of these companies, maybe you could talk a little bit more about it. And I don't want to get too much into it, but when I look at a company like Fission, Western Athabasca, I mean, there's no infrastructure here. And I mean, you're talking about, they talk about the deposit, the grades are amazing, everything's great. I mean, it's going to cost, from what I've seen, easily about $500 million, probably a lot more than that, to actually develop this stuff. And you're looking at prices where the break even for something like that is probably 70, 80. We're still under 30, really. So I don't know if these are the best plays, right? We've seen at junior miners where the junior miners weren't really the best plays. Actually, the majors, the more quality companies, Equinox, the ones that are producing are the best plays. So, a lot of these companies I'm seeing in these areas, it's pretty crazy.
Like one thing that I kind of can't even believe the exchange allows, and I've gone up on stage and I've literally had these IR guys try to troll me online, and everyone's a tough guy socially. So I went up to the guy at this conference. I said, hey, I'm right here. I dare you to say to me what you said online. And the guy shit himself. Get the fuck out of my face. The point here of what I'm trying to get at is how the hell, like, Frank, if you read a feasibility study, a bankable feasibility study, and it said, look at these amazing economics at $2,500 gold, what would you say to the company or the analyst?
I'd say you're crazy.
But why is it acceptable? Yeah, but why is that acceptable at $50 or $55 uranium?
Yeah.
But you just told me at $2,500 gold that you'd be laughed out of the park, and I totally agree with you. But we're at $1,500 gold, or $1,475, whatever. That's not even a double. We're at $25 uranium, and everyone feels it's acceptable to have a $50 or $55 base price for uranium in their feasibility study. And nobody's calling out that. I'm sitting here going, all right, good luck with that.
Yeah, no, we'll move on because this could be a whole conversation on itself, because I wanted to get into a big event that's coming up. I know we would have fun with this one, but a big event that's coming up, which is the Vancouver Investment Resource Conference. Talk about your role in this conference, first of all, because it's more than just, a conference that you attend. And, some of the things that investors can expect for 2020, because, it has been mostly a bearish market. 2019 was better, but I'm just curious, what could investors expect that are going to actually be there?
Okay, so we've got truly a star-studded lineup. Obviously, my close friends like Ross Beatty, he's actually going to open the show with me on Sunday, and then he's literally straight from the show. He's going to the airport because he's going to Davos. Right after that, they're gonna all these billionaires get together to solve.
Yeah, that's another level, Davos.
So then I got Conrad Black. I don't know if you remember that name or not, but he's a very, very, very controversial Canadian. He was a media mogul. Donald Trump pardoned him. He was in jail, so I'm going to get him up on stage. He's an incredible writer. If you ever have a chance to read his books. So I'm going to have him up there. And interestingly enough, I got the actual founding scientist of Greenpeace. This is a guy that a lot of people forgot about, Dr. Patrick Moore. And I'm bringing him up on stage. And I'm basically going to, for 30 minutes, we're just going to find the dirty secrets of Greenpeace, the truth, the good, the bad, and the ugly. I have no agenda against Greenpeace, but here's a guy that was there from day one, and now he's at war with the guys who took over Greenpeace, and we're going to see about what behind the scenes, the NGOs, and what the true agenda is behind the stuff for resource development. So that's going to be fun. Stephen Moore is coming, Trumponomics, the book. Mm-hmm. So him and I are going to do a one-on-one live, and really those are great. Ross will tell you how to make money. The other guys are interesting. They're not going to give you specific stock picks, but then I'm bringing the best names in the industry. They're up on stage, and then I'm going to talk about who I think is going to be bought out and why, and bring them up to the show, and people can see firsthand if Marin's right or wrong or whatever. But you'll leave with a lot of interesting investment ideas to think about, and I think it's a great show. We're expecting around 10,000 people at the 2-day show, and once we put up that Frank Curzio is coming, we took maximum square footage because we expected all the female audience to start buying tickets to the show. And for all your listeners, because you're a Curzio fan, you get in for free.
No, we'll definitely put a banner up on the site, and that's for 19th to 20th. I think once that announcement is made, I think it might go down. It might go from 10,000 to 8,000. So hopefully it doesn't. All right. So you're saying investment ideas. Let's end with this, buddy, because you're only as good as your latest pick. So you're good right now with Equinox. You're good with Liberty Gold. But I'm kidding, but it's so true. Thanks. It's investors think. But I'm
going to give you 3 ideas. I'll give you 3 ideas. And my style. I like advanced assets. I don't like early stage. I don't like backing a geologist with a box of crayons. I like buying intrinsic value. So one that I believe is going to get bought out is Pretium. Pretium is a very controversial asset because it's so high grade, and it's, is it 11 grams? Is it 8.5 grams? Well, it's variable, and some quarters it's going to be 9 grams. Other quarters it's going to be, the average head grade will be 8 grams, and then you'll see 10 grams. The company, they built this thing. They've done it fast. It's run by Bob Quartermain, who's a legend in the business, a truly underrated superstar, just a great, great guy. And I look at it and say, okay, how is it going to get bought on? And I published this, Frank. This is what I truly think. You look at these big caps. A mid-tier can't buy that because the share price, it's exposed too much. It produces over 350,000 ounces of gold, this one mine. But if the difference between 8.5 grams to even 9.25 doesn't sound like much, but for a single asset company or even a company with two assets, that's a big variance. And analysts get nervous, and everyone doesn't know how to model it because it's so sporadic, the grade. Okay, but what if you're a big company that produces 4 million ounces? It's a decimal point to those guys, and they really don't care if it's 8.5 grams or 9.5 grams. Of course they want a higher grade, but it ain't going to rock their boat, that difference. Now, if I was one of these big caps, first thing I would look at is, where are my biggest tax losses historically that I have on my books? And then I could, use those credits with the government to reduce my cost of capital. And Barrick has historic tax losses for the assets in Canada through the companies they've bought out. Those don't just disappear. So when they ended up with all these assets from the old Placer Dome days, you have these assets. And yes, a gold deposit's an asset, but so is a tax loss. It's a financial asset on the balance sheet. So I believe Barrick will buy out Pretium because the cost of their capital to buy out Pretium will be cheaper than anyone else's because of that tax loss credit. That's one idea. Another idea that I'm very bullish on is your old buddy, Jonathan Ott. Now, a lot of people may not know this, but I was a major shareholder in the pre-IPO over 10 years ago. My style, I waited very quietly. This guy's a superstar. He is in the league of Amir and Ivan Bebek, and he's our generation for the next generation, like the Ross Beatties of the world. And his company, because big funds like BlackRock, off the top, had to sell anything under $1 billion market caps. The share price suffered. But they've advanced their assets. They have their study out, their PFS. And you look at this and say, just little things. Like when I went through it, I went, geez, I was surprised that they didn't, like the equipment, if it a truck you don't really need to buy, you can lease it. And what we did at Copper Mountain, when we leased our huge fleet, the upfront cost is way different. Now, don't get me wrong, longer term, but it's all about my cost of capital today. So right off the bat, they can reduce their upfront cost easily by 25 to 35 million, depending on the specific fleet that they have, by leasing it. And in their study, I just redid my model, and I'm like, wait a second, there's a lot of low-hanging fruit here. And I think a mid-tier company or someone even larger can look at those assets and say, we don't need to buy nice, shiny new trucks. We can lease these things, and because our cost of capital will be lower, I think Gold Standard Ventures will be gone in 2020. Then I think the big wild card here, let's go back to the two big boys. I think Barrick's going to do something very, very interesting. And what I would do with them, a lot of people don't know that they have a 2-year non-compete with Newmont. That's the second largest producer in the world. But the real assets that Barrick wants are the American assets. Remember my whole theory that, I'd rather be exposed to U.S. and Canada than elsewhere in the world because I think the risk is less at home than outside. But the last 20 years, it's been the opposite model. I think Barrick will go after Newmont, but they can't do that right now. But a better idea would be if someone like Newcrest went after Newmont, took all their big porphyry projects, and Barrick ended up buying their Great Basin assets. So that's a very complicated deal, but I do believe Barrick will end up owning Newmont's in the next 2 or 3 years. But next year, I think Freeport will be gone, and I think Barrick should make a move. Now, you're talking about Indonesia and, Grasberg, big, like that's like putting Pebble into production, but it's in production, but it's a tough area. Again, there's only a few balance sheets that can afford it and deal with the volatility of the government and not rock their share price. And I think that's a Barrick move. I think Mark Bristow's looking at Freeport too. So there's 4 ideas there that I think, 2 or 3 could happen next year. But, I'm publishing ways on how to play Pretium to get your maximum bang on your buck. And I don't know if it'll happen in March, April, or November, but I do see it happening. So that's kind of the stuff we're looking at.
Yeah, so lots of ideas there. We covered a lot, like we always do, Matt. I really appreciate it. Look forward to seeing you in Vancouver. And just one last thing here. Do you have your Santa Claus suit? I mean, with your kids now, you got to dress up like Santa Claus, don't you? We all got to do it, man.
For the red velvet.
I know, to bring everybody in. Yes, Marin used to be a rock singer back in the day, and I did see videos of it with him with leather pants. So that's why he's saying that. But that was awesome. But we always got to get.
I guess it's fitting that I don't fit in the leather pants, and I think the velvet is a more comfortable outfit for myself. And
Nah, it's definitely true. Well, listen, I know how busy you are. Thanks for stopping by. I really appreciate it. And I'm going to see you a couple of weeks. And if I don't talk to you before the holidays, make sure you and your family have a great holiday. But I probably will.
You too, buddy. All right, take care, man.
All right, guys, great stuff from Marin. I love having him on. He wears his emotions on his sleeve, which I love, as you could tell. A couple of curses there, which are cool. It shows the raw emotion. But I was with him with that Equinox deal, and he did take a lot of shit for that deal. I mean, he put together some of the biggest names and resources. You saw how hard he worked, and I know there's a lot of short sellers that attacked him and went after him, and it was tough on him. It was definitely tough. It's not easy when you're doing something where everyone around you is just like, doubting you and telling you he's full of shit or this and that. And, look where that company has come, and I have to give him credit because, he's a grinder. And he said something interesting, too, where he's like, well, I'm not the smartest, and I kind of feel the same way. Like people say, well, Frank, stocks, you're smart. It's not that. I have a passion for this, and so does Marin, where we just work harder than everybody else. I mean, I love this stuff. I'm working all the time. I just, this is my life. You could tell Resources, it's his life as well. But for any of you guys out there, especially new Curzio One members that are going to be, in Vancouver. Also, I'm going to be attending the Consumer Electronics Show from January 5th to the 10th. And I believe the Vancouver Investment Conference is the 19th and the 20th. I'll put a banner up. Do not go get any place else because you guys are going to get them for free. Marin always offers that deal to you guys. So if you're in Vancouver, you can go to that conference for free. I think it costs like $200-$300 or something like that. So you guys don't have to worry about paying anything. But I'll put a banner on the site, and I'll let you know as we get close to that, probably early next year. And last note here, I just want to say thank you. I mean, the demand for Rich Sutmeyer's 2-second trader newsletter, it's the first product we launched here in close to 18 months. Demand's been very strong. We received lots of positive reviews as, Rich just made his first trade last week and his next one's coming out on Friday. But if you're still interested in subscribing, make sure you do so through the link that we're sending you. And if you're not getting that link and you're not seeing that deals because you're not on a free mailing list, just go to our website, CurzioResearch.com, put your email address in there. But if you're thinking about subscribing, do it soon because this offer is going to end this week. And after that, we're going to be selling this newsletter for the full price, which is, about double the price that I'm currently offering you right now through this link. So if you're interested, just a few days left. Great deal for the newsletter. But I just want to say thank you for everyone who subscribed. I really, truly believe you guys are going to be very, very happy you subscribe to that product. Again, I want to put out great products in front of you with great people who are passionate. Rich is passionate, calls me all the time, just totally into the markets. This is his life. He loves it. These are the people I want to try to put in front of you. And I'm happy you joined us. I'm happy we got his black box system on the site, which you guys could check your own stocks on, which is an added tool. So you're getting more than just Rich in his newsletter. But I just want to say thank you. And guys, if you're interested, just make sure you sign up through that link and that deal because that's going to be the best deal that you're going to get. And if you do so, please, or if you're going to do so in the next couple of days because I think we're pulling out either Friday or Saturday or very, very soon. So again, I just want to say thanks for all the support. So guys, that's it for me. Man, holiday season's here. It's crazy getting everything done. This way you could give your employees and everybody else off. So, it's nuts. Hopefully you guys are going to have a great holiday. I'm going to be publishing this next week as well, which is going to go out on the 25th. I'm going to tape it a little early, but I'll have something for you. You could listen to it the 26th, 27th, but I'll definitely have a podcast for you. I'm not too sure. I think I am going to have a guest. Actually, I'm going to have a good guest. There's a guest that was supposed to be pushed out, but I think we're going to have him for next week's podcast. So he's a fund manager, very big fund manager for a very long time. Look forward to interviewing him, and you'll get that podcast. It'll be published on Wednesday, whenever, but that is going to be the 25th. But there's definitely going to be a Wall Street Unplugged podcast on then. So guys, that means I'm going to see you in 7 days. So take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.